Is the stooping stock market preventing you from investing? I mean, NASDAQ just went down 35%, so the signs aren't subtle. For the average Joe, the recent stock drops can be frightening. However, business geniuses like Ackman and Warren Buffett would beg to differ, which is why they are drowning in dollars while we try to crack the code on YouTube. Do you want to become the next Bill Ackman? Then get a Harvard degree. Just kidding. In fact, becoming as rich as Ackman requires the exact opposite of a Harvard MBA. So what makes Ackman a pro at the investment game, and how can you follow in his footsteps? Stick around because in this video, I'll deliver all the answers. We'll cover everything from the ABCs of stock investments to Ackman's iconic checklist. But before I tell you why descending stocks are the best thing, hit like and subscribe. Now let's get to the good stuff. A blessing in disguise. We have established that the stock market is at its worst right now. But contrary to what most investors believe, this can be good news. Why? Let Bill Ackman explain. Investors like Ackman are never focused on the highs and lows of the stocks they purchase. Instead, they care about the quality of their stocks. So why don't the crashing stocks make this guy break into a sweat? According to him, this is the best opportunity to enter the stock market. It's simple. His goals are long-term. Regular investors care how much profit they will make in the next 10 months. However, a billionaire mindset thinks about the next 10 years. According to Ackman, we are currently in the rising interest phase of investment, which means stock prices will keep stooping. However, this is a blessing in disguise. Next up, we look at the bigger picture to understand why. The logic. To understand the stock market trends, you should understand the direct relationship between inflation and interest rates. The current inflation in America is the worst in generations. Scary? The federal government thinks so too. So they are actively increasing interest rates. But why are they doing this to us? What good would come out of it, you may wonder? By raising the interest rates, the government slows down the economy. This means people won't borrow money to buy a new car or home. Ultimately, it reduces demand and the overall economic pace retards. So, when you buy less, there is an excess product in the market. Ultimately, shopkeepers try to sell the excess inventory by lowering prices. All of these measures eventually result in decreased inflation. Sounds good, right? With less inflation, everyone's happy. Not so fast. Remember the high interest rates? These won't just make it hard to get a loan for a new car, they will also affect stocks. Another investment genius, Warren Buffett, once called interest rates the gravity of stocks. Just as it is hard for you to borrow money to buy a car in a high-interest environment, it's hard for companies to borrow money to invest in businesses. A higher interest rate means your stock will make fewer returns over time. Ultimately, higher interest rates decrease the intrinsic value of your stock. All this information might make you want to avoid investing in stocks. However, this next point will convince you otherwise, so if you want to reap long-term benefits, stick around. The future of stocks. The situation might not be ideal right now. In fact, it might even worsen in the next 4 or 5 months. However, the government will eventually get inflation under control. When it does, the interest rates will drop to balance the economy's pace again. So 5 years from now, the stocks you buy will be soaring. Now, despite technology's best efforts, we haven't been able to see the future. So how can we be 100% sure that the government will indeed control inflation and lower interest? You'll understand with a quick history lesson. In 2019, the government was trying to deal with deflation, which is the opposite of the current scenario. Therefore, with time, the economic landscape witnesses opposing situations. This is why these balancing tactics exist. Now, coming back to the point, what did we learn? We learned that we should use the sorry situation of the stock market to our benefit and make suitable investments. Eventually, when the scenario changes, the national monetary policies will follow, and you'll win a lost game. This is what makes billionaires different from regular investors. They trust the process and seize an opportunity at the right time. So you're convinced that this is the best time to invest. Next, we look at Ackman's list of successful investments. Be sure to stick around for point 4 because that's his best kept secret. Ackman's checklist. Ackman has devised a list of stock choices to make investing safe and easy. So without delay, let's catch you up on it. Let's see what makes a purchase worthy stock, especially if you're a beginner. Number 1. Simple stock. Remember how I said you don't need to follow Ackman to Harvard to get rich like him? This is why. Contrary to his high-end academic profile, Ackman's business portfolio comprises simplicity. Some of his stocks include restaurant businesses like Tim Hortons and Chipotle. In addition, he has investments in home improvement, railroad, and hotel enterprises. All these enterprises are straightforward enough for an average person to understand. We all know how the restaurant business works, how to profit from it, and what influences this and similar companies. In contrast, if you bought biopharma stocks, it wouldn't be any better than a blind investment. Next, we discuss one quality that makes a company worth buying. Knowing this could cause your first investment a sure hit, so don't miss out. Number 2. Predictability. You might like the idea of electric cars or AI technology. These are new phenomena that seem to have potential. But have they been around for long? Have they proven to be profitable over time? The thing about innovative startups is that they have as much chance of failing and going bankrupt as they have of becoming a billion-dollar enterprise. Ackman doesn't advise investing in them just because they have innovative potential. In contrast, businesses like real estate have been around for years, and we all know they are profitable with annual rent increases. So you may not become filthy rich overnight, but you'll surely get yearly profits. The question is simple. Would you want a secure 5-year plan, or take the risk for a 50% chance of becoming the next Elon Musk? Maybe when you become as rich as Ackman, you could take the risk too, but until then, it's better to stay safe. However, I doubt you'll become like him by doing the opposite of his advice. Is predictability enough? Nope. There's something even more vital to consider when purchasing a stock, and I can't guarantee you'll make a fruitful investment if you miss this. Number 3. MOAT. One guy figures out people love coffee, so he gets rich by selling it. But then another guy sees him and starts selling his coffee with more flavors and a slightly lower price. This is an example of competition in capitalism. In most cases, where there is a business, there is competition. Ultimately, the competition could threaten your stock. This is where a moat comes into the picture. Imagine a diamond in the museum. It is protected by top-notch security and scrutiny. The diamond is a company's profit, and the safety, i.e. the moat, prevents competitors from taking this profit. So, the better your security, the safer your profit is. Let's take a look at Ackman's portfolio. He has invested in businesses with the most significant moats. One example is Canadian Pacific. This railroad enterprise has train tracks and expensive and time-consuming infrastructure. If someone wanted to compete with their business, they would need a lot of capital and technical approvals to set up their business. This is why Canadian Pacific is only rivaled by Canadian National. Hence, the profits are divided between the two enterprises, ensuring good stock value. Next, we have the last criteria, which guarantees a good investment. Let's dive into it. Number 4. Discount value. To understand Ackman's last point, you need to know two phenomena which measure a stock's worth: its intrinsic and trading value. A stock's intrinsic value measures how much cash flow it generates. On the other hand, the trading value is what it is selling at currently. The ideal way to buy a stock is to purchase it when the trading value is less than its intrinsic value. This gives you a margin of safety. If you follow Ackman's strategy, you will have a concentrated portfolio like him. Concentrated portfolios often don't allow much room to mispredict a stock. Consequently, you could lose a lot of money if you don't keep a margin of safety. So, as a last trick, try to buy stocks selling at less than their intrinsic value to enjoy a safe and fruitful portfolio. This concludes Ackman's cheat sheet for climbing the economic ladder. So now you have 4 simple points to look for when buying a stock, and you'll be on your way to a brighter future. However, before you begin your journey, subscribe and share with friends to take them along. Happy investing!